Good morning. You're watching Market Cafe on ET Now with me, Shreyanti Singh and Kanishka Sarkar. Over the next 1 hour, we'll get you updates from within the country as well as across the globe. Also tell you which stocks you should be keeping on your radar. Well, speaking of stocks first, Kanishka, let's take a look at the handover coming in from the Wall Street and quite a mixed bag that we're looking at.
Absolutely. Investors last week as well remained on the edge after President Donald Trump's sweeping April 2nd tariff announcement, which has stunned the markets and sparked some of the most volatile trading sessions since the pandemic 5 years ago. Now, last week, each of the three major averages logged a third weekly decline in the last 4 trading weeks. Now, in the truncated week, while the S&P 500 closed out Thursday's session higher, the broad market index still finished the holiday-shortened week 1.5% lower. Now, additionally, the Dow Jones Industrial Average and Nasdaq Composite posted their third consecutive losing session, each finishing the week more than 2% lower. Now, after rebounding somewhat in the previous week, S&P 500 is down about 14% from its February record high levels. Dow is down about 13% from those levels, whereas the tech-heavy Nasdaq index is down nearly 20% from its record high. In fact, the all-magnificent 7 mega-cap stocks are sharply lower in 2025, with Alphabet down about 20% and Tesla off 40%. Now, going forward into the week, a heavy slate of U.S. company results during the week will test the stock market that's shaken by a U.S. trade policy overhaul. Now, Tesla and Google parent Alphabet are among those closely watched for financial results as investors seek some guidance about the fallout from tariffs that we have been seeing over the weeks.
Well, absolutely. So there you go. That's the handover coming in as far as Wall Street is concerned. With that in mind, let's move on. Take a look at oil prices because they did rise more than 3% after the United States imposed new sanctions coming in to curb Iranian oil exports, also elevating supply concerns. So when you take a look at Brent crude futures, you're looking at a rise of 3.2% coming in. $67 a barrel is the kind of level that you have in mind when it comes to Brent and US WTI as well. Settled around $64 and that's an uptick of 3.5% thereabout. Even for US WTI, but both benchmarks in fact booked their first weekly rise in 3, so you did have that coming in. That's very important to mark. Gaining about 5% for both of these benchmarks, and Thursday of course was the last settlement day of the week ahead of the Easter holidays, so it was a truncated week as far as oil was also concerned. New sanctions in fact on Iranian oil exports is something that you're looking at in terms of factors. Other than that, you do have hawkish comments coming in on the issue from the US Treasury. Also increasing supply concerns helping support crude as well. And adding to supply concerns, you also have Organization of Petroleum Exporting Countries or OPEC that said on Wednesday that it had received updated plans for Iraq, Kazakhstan and other countries also to make further output cuts to compensate for pumping above quota. So that's also something that you are looking at as far as supply side factors are concerned, but largely an uptick is what you have as far as Brent and WTI is concerned.
Absolutely. Those are the cues when we're looking at oil. Now, moving on, lots of events to watch out for today. For instance, in China, the loan prime rates are going to be out today. In terms of corporate action back home, M&M Finance Board is mulling a fundraise. Now, in terms of other key events, spring meetings of the International Monetary Fund and World Bank Group are due later in the day. Also, a very important event to watch during the day is U.S. Vice President J.D. Vance's India visit that begins today. Apart from that, Chicago Fed President Austin Goolsbee is to speak later in the day.
Alright, then moving on, let's kickstart our coverage with the top headlines we're tracking this hour. Then as owners and CEOs stock up inventory and panic buying picks up in American markets, you do have some key Federal Reserve officials who've also voiced concerns around artificial high level of economic activity. In fact, in a televised interview, you do have Chicago Fed President Austin Goolsbee saying that consumers accelerating purchasing decisions may inflate US economic activity in the month of April, also lead to a slowdown in the coming month.
All right. Meanwhile, the U.S. president has attacked the head of U.S. Central Bank, Jerome Powell, for refusing to cut interest rates. Now, he says that he should be terminated from his position. Trump specifically said that he could fire Powell if he wanted to. That's renewing a threat from his first term that could cause a major legal showdown over the issue of the central bank's long-standing political independence. Now, remember, just last week, Powell was heard reiterating the central bank's stance, saying that their independence is a matter of law and that they are not removable except for cause, largely attributing to the committee's long and endless terms.
Another week and another war of words coming in as far as US President Donald Trump is concerned, but shifting focus to Beijing then, where the PBOC has expectedly kept its loan prime rates unchanged, with the 1-year LPR, that's the one that was at 3.1%, 5-year as well at 3.6%, as the central bank appears to prefer stabilizing the yuan amid trade tensions with the US. The decision comes as China reported better than expected economic data this month, with first quarter GDP also growing at 5.4% on a year-on-year basis. Remember, retail sales as well as industrial output numbers for the month of March also beat expectations.
Absolutely. And now back to some news flow from the US, where the Trump administration could soon roll out sweeping changes to the US State Department, according to a draft executive order that lays out what it calls a disciplined reorganization of the nation's diplomatic service. The 16-page draft order, which is not dated but appears to be prepared for Donald Trump's signature, would dramatically upend the department if it is enacted. Now, the order also details an overhaul to the process for selecting and training US diplomats. The draft executive order proposes the elimination of all non-essential embassies and consulates in the sub-Saharan Africa and the consolidation of regional bureaus around the world.
Alright, then moving on, in important events to watch, US Vice President J.D. Vance is all set to begin his 4-day visit to India today as he and his family descend on the national capital later today. The family, in fact, is going to be landing at Palam Airport, where senior ministers are expected to receive them. Remember that this visit comes amid the global concern over Trump's tariffs. Also, talks between the two nations that remain crucial at this point. We do have Sumita Kariru standing by on the phone line to get us more updates. Sumita, take us through the importance of this meeting as well as what the agenda looks like.
Yes, in fact, United States Vice President J.D. Vance will be making his India visit. He will be arriving in New Delhi today, and today at around 6:30 p.m. is when he will be meeting Prime Minister Narendra Modi. The two sides are expected to have a diverse range of talks. They will have talks around, according to what sources are telling us, around energy diversification, economic and geopolitical priorities, and early finalization of the bilateral trade agreement along with the tariff strategy, and of course around defense and technology. April the 22nd, which is tomorrow, is when J.D. Vance will be in Jaipur. He will be addressing a gathering at Rajasthan International Center. That speech will be interesting to watch out for. And then he goes to Agra on the 23rd, and 24th is when he departs for the United States of India. Now, so far as shared priorities of the United States administration and India is concerned, well, there are a couple of like I said, a couple of priorities that are important to both, including energy diversification, including defense technology. We do know that there is a trust initiative that was built, a couple of years back. And this year, in February, when the Prime Minister visited the United States to meet with Donald Trump, that trust initiative was given a further boost. Now, why is this visit important? Because it's going to be the first key visit from the U.S. administration, besides, of course, of Tulsi Gabbard, that is being looked at with a lot of interest, given that it comes amidst the 90-day pause on tariffs, and also at a time when the United States and India are negotiating a bilateral trade agreement to increase bilateral trade between the two countries by $500 billion. So this visit is expected to also pave way for deeper collaboration and bilateral ties. Remember, as far as trade is concerned, tariffs is concerned, we do know that USTR representatives visited India in March. Of course, now we are also given to understand that Indian officials could be visiting United States from India on April the 23rd to discuss the modalities of the first tranche of bilateral trade agreement, which had actually finalized 19 chapters, which cover various areas, including goods, services, non-tariff barriers, rules of origin. So this is going to be the first meeting since the terms of reference got finalized, and which is why it is being looked at with so much of interest.
Well, absolutely. A very important meeting coming, a very important visit from U.S. Vice President J.D. Vance later in the day today. Now, it's very important, especially given the tariff chaos that the world has been witnessing, and also with respect to the trade ties between India and the U.S. With that, it's time to take a very short break. We'll be right back. Stay tuned.
Welcome back. Thank you so much for staying tuned in. Well, it's time to take a look at the Asian indices, and in fact, you do only have just a couple of markets that are working. The rest have shut shop for Easter holiday as well. So at this point, let's take a look at the ones that we have at hand, because you do have China's central bank that we told you about in terms of the loan prime rates. But moving on, when you take a look at Japan's benchmark Nikkei, that's the one that fell 0.8% thereabout. That's the market that I'm talking about. There you have it, 0.9% decline coming in for Nikkei as well, and South Korea's Kospi as well. That's the other index that is operating today, edged down just about 0.6% thereabout. You do have Australia and Hong Kong markets that are closed for the Easter holiday, like I just mentioned. And in fact, back home as well, on Friday we shut shop around, on Thursday in fact we shut shop around 23,851. And in terms of what you're looking at, when it comes to the handover, you do expect a muted start at this point. Not a very good handover coming in as far as Wall Street is concerned. Not a great handover coming in as far as Asia is also concerned. So that largely is what you're looking at as far as Asian markets are concerned.
Well, absolutely. Those are the cues that we're tracking for the Asian market.
From focus to earnings, then let's take a look at IT. In fact, let's take a look at Infosys in particular, because you did have a muted fourth quarter coming in. As far as Infosys is concerned, you did have a margin beat coming in for the company as well, and there's weak revenue growth guidance that the company has also shared. So IT's cautious mood continues, and as Infosys also reports a weak quarter along with guidance, the company in fact continues to find its footing even as deal wins also remain steady. On that note, let's also go across and listen into the word coming in from the management of Infosys when it comes to their large deals then.
So we feel well positioned in this environment to look at both growth and both cost areas as clients look at them. We see there's uncertainty in the environment. In terms of mega deals, we had 2 mega deals in the last financial year. We have a pipeline of mega deals today. What is sort of what we saw in the past when things of this nature happen, which is changes in the environment. There's also an interest with clients on cost takeout, automation and efficiency and consolidation. We will see how it plays out because it's only a few days as clients have looked at it. But we have seen our large deals moving, meaning which we have closed, moving into the next phases as was evident.
Yeah. So on the guidance, as I said earlier, there are multiple models that we have built. At the bottom of the guidance, we have assumed, heightened impact from all the macro environment. And on the top end of the guidance, we have assumed steady to marginally improving, environment.
All right, then moving on, SEBI has released a consultation paper on MF investments in REITs and InvITs, suggesting a relaxation in investment limits to boost capital flow and diversification. Now, my colleague Anurag Shah is standing by with all the details. Anurag, over to you.
Capital market regulator SEBI has released a consultation paper on mutual funds investment in REITs and InvITs, and the paper focuses on relaxation in investment limits to boost capital inflow and to have a more diversification. So main proposals are that SEBI proposes to classify REITs and InvITs as a equity for inclusion in equity indices. Other than that, SEBI has also proposed for increasing exposure limit for equity in hybrid mutual fund scheme. So mutual fund scheme which will be investing in REITs and InvITs. So exposure limit has been proposed to be revised to 10% from current 5% for equity schemes, and overall cap is proposed to increase from 10% to 20% for equity and hybrid scheme. For debt mutual fund, SEBI has proposed to retain the current 10% overall limit due to higher risk profile in these instruments. SEBI is not in favor to have a dedicated mutual fund scheme of REITs and InvITs due to low liquidity. So SEBI has invited comments from all stakeholders by 11th of May 2025.
All right, thanks Anurag for all of those important details coming in. But moving on then, Zomato's board caps FII ownership at 49.5%. as domestic funds now dominate shareholding post its 8,500 crore QIP as well. In fact, Elara says that this shift supports data norms as well as inventory control. Rabinder is standing by with some more details. Rabinder?
Well, yes, Zomato, which is now eternal, can be in focus, where the companies plan to set a cap of 49.5% on total foreign ownership, and this include investment from foreign individual or entities such as foreign direct investment, foreign portfolio investment, NRI, etc. This cap will apply to all equity instrument, including shares and convertible securities, on a fully diluted basis. And Elara maintain a buy rating on Zomato with target price of ₹300 per share. They say that this move will follow Zomato's QIP fundraising of 8,500 crore in November 24, which was at least 48% subscribed by the domestic fund, and ownership post QIP of December 24 stand as FII 47.31% and DI 20.51%.
Right, thank you, Ravinder, for all those details on Zomato. Now, moving on. VVDN Technologies has set up a new facility to boost electronics production. Now, IT Minister Ashwini Vaishnav inaugurated the facility. Now, VVDN is looking at scaling the design of electronics and take into full-scale manufacturing soon. It also expects to grow more than 50% over the next 3 years. Listen in to what the CEO had to say.
What we are doing here is a full-scale design of a lot of electronic products and then taking them to manufacturing. We are working in multiple market segments, which includes telecom, automotive, IoT, networking. But on the background here, you see, for example, we are doing a lot of IT hardware. We are doing tablets, laptops, servers. So this is like a mind shift game of India, where not only we are doing manufacturing, all the products are designed from very grounds up and then taken into manufacturing. And these products are going to the whole globe.
Puneet, help us understand how much of a role have government schemes played in scaling up this facility, scaling up your expertise, and now that you're designing as well, how much of government policies have aided you in accomplishing this feat?
The direct government policies like PLI, the government launched a IT PLI almost a year back, which is boosting not only the manufacturing, again design of a lot of the devices in India. So that schemes are in place, and this is not only helping to create the manufacturing, but also it is inviting a lot of global players to come to India and look for doing the design and manufacturing with Indian companies. I think business happens on the perspective of the whole world is changing towards India.
Right. So you're already producing, electronics products for companies like HP. You've also announced that partnership with ASUS as well. Give us a sense of the kind of partnerships that you're looking at forging. How many companies are you currently in touch with, and how many of those will eventually get sealed?
So I think it has been an amazing last 4 years for us, right? We are now recognized as a global brand, right? And with the geopolitical situation, there are a lot of global large Fortune 100 companies which are looking for alternate location to other countries, Asian countries, and India can be their favorite destination.
I want to understand the kind of capacity output that you're looking from this particular facility and from across the other facilities that you have. I believe you also have 2 other facilities coming up soon.
Absolutely. So I think we have almost like a capacity of 2 million square feet here in terms of manufacturing. And in terms of revenue, we can deliver more than $1 billion revenue from these facilities.
So these new facilities that are going to be coming up, you've mentioned that medtech is one sector that you're going to be looking at, but what are the other sectors that you're looking at with respect to manufacturing in particular?
So our growing sectors are automotive, telecom, and the new sector which we are entering into is railways, aerospace.
One final question. What is the overall growth projections that you have, particularly from this particular plant for the next 1 year?
See, we've been growing like 50 to 70% from last few years. I think we will continue to grow more than 50% year over year, at least for next 3 years.
All right, tell you what, let's shift focus right back to earnings then. In fact, it was a great start to banking earnings. Heavyweights HDFC Bank and ICICI Bank posted better than expected numbers, with margin expansion as well as asset quality improvement that we saw coming in the fourth quarter, along with lower slippages and credit costs. In fact, both banks also gave stable outlooks, with ICICI also saying that retail stress, in fact, has bottomed out. HDFC is also aiming for CASA gains and a lower CD ratio going forward as well. Gaurav is joining in with a comprehensive picture. Gaurav?
Well, yes, when we talk about HDFC Bank and ICICI Bank, both banks reported a very good set of numbers. In fact, when we look at profitability, both both the banks reported above estimated profitability growth for Q4 FY25, but there were other highlights from the quarter. So first, let's talk about net interest margins. Now, both the bank have actually shown some kind of improvement in net interest margins, whereas the street is expecting net interest margins to remain stable or decline a little bit. And when we talk about this gain, it is not just one-off gain. The banks has said that it is actually something that can be factored in even from here on. So first, let's talk about when we talk about HDFC Bank, we have seen 3 basis point of gain in net interest margins, which they have contributed to the cut in CRR ratio. On the other hand, when we talk about ICICI Bank, a 16 basis point of improvement in net interest margin, and bank has clearly stated that it is not actually a one-off thing. It is a combination of multiple things which has actually led to the net interest margins of 4.41. Although the bank has said that from here on the long term basis, 4.3% of FY25 is something that we can look as a representative for the bank, but definitely a very positive thing in fourth quarter. Second is that when we talk about asset quality, both the bank have shown some kind of improvement in asset quality. In fact, when we talk about net NPAs, they have gone down almost by 3 basis points for both the banks. In fact, when we talk about HDFC Bank, we have already seen slippage ratio at 1.2%, which is actually lowest among the peers when we compare it with the large banks so far. Other than that, when we talk about ICICI Bank, there also we saw gross NPAs going down almost by 20 basis points because the bank actually sold one of their portfolios worth 2,700 crore rupees. When we talk about loan and deposit growth, there also we saw a very good set of numbers. In fact, when we talk about ICICI Bank, we saw loan book growth was actually a little less than what the street is expecting. But from here on, what bank is saying is that the personal loan and credit card segment has actually, the growth there has bottomed out, and from here on, bank will continue to grow at a pace which will be faster than the system. On the other hand, when we talk about HDFC Bank, we already knew that in FY26, HDFC Bank wanted to grow at a system level space, and they have continued to believe that as well. In fact, what they have also said is that the CD ratio will come down to around 85 to 90% gradually. So definitely another key trigger here. And lastly, when we talk about way ahead, there also we are seeing some kind of positive triggers coming up from the commentary from banks. So when we talk about ICICI Bank, although both the banks have agreed that the rate cut impact is going to be seen in Q1 FY26, but the increase in CASA and deposit growth is something to be watched out for, and that is the reason why they believe that the impact on the net interest margins will be limited. So definitely a very positive set of numbers from both the banks, and on back of this, we have already seen that brokerages have also upgraded the target price, and on back of this, we will also be watching out on how the stock will perform. But as of now, Q4 was a very strong set of numbers for both the banks.
Thank you, Gaurav, for that quick report card of the Q4 numbers as far as HDFC Bank and ICICI Bank are concerned. But let's also listen into what the management's take is on the Q4 numbers for both HDFC Bank as well as ICICI Bank.
Credit deposit ratio has been brought down from the highs at the time of merger, which was at about 110%, to around 96% as of March 2025. Our deposits have grown faster than the system, and so has it grown faster than our loans as well. Next year, in line with what we had committed, the adjustment in CD ratio will not be so steep, supporting the loan growth for the bank, but it will be on a downward path.
You saw the NIM for us over the last 12 months, if you see, operated in a very narrow band. And there are two things going on in the cost of funds to be stable there. One is the borrowing mix has come down during this time period. Whatever is on the page there, you see that the borrowing mix in the first of the time period, December 23, was 21%. And then from then on, last March, it was 18%, and now it is 14% borrowing mix. So that's one of the tailwind that contributed as a positive item to the cost of funds. Then there is a headwind in the cost of funds we have seen is the customer preference towards time deposit.
As far as the loan growth is concerned, I don't think anything specific incrementally in terms of caution on the credit side. I think we are pretty comfortable with what we are underwriting. Of course, on personal loans and cards, as you know, we had tightened, a few quarters ago, and that is showing up in the volumes over the last couple of quarters and the loan growth. But other than that, no specific caution on the credit side. I would say it's largely a function of what is happening in the system. And also, I guess, on the pricing side, some consciousness given that,
during this quarter, we were at the sort of cusp of the, downward movement in benchmark rates. So we had to be, I think, a little more, I would say, disciplined in terms of the spreads, etc., that we were charging over the benchmark. But other than that, no specific caution. So there was no one-off in the yield on advances. I think probably the largest component driving up the yield was what we had spoken of, in I think Q2 and Q3 last year, which is the benefit of the day count. Margin number to focus on in our mind is really the 4.3% for the full year. That would be a more representative number.
All right, then good start coming in as far as banking earnings are concerned in the fourth quarter. But let's move on. Let's get you some key commentary then. In a 90-day pause on 26% tariffs is a positive move, but the threat of a global tariff war at this point still continues to linger. How will Indian markets then and the economy then brave the storm? And is India better placed as compared to other nations? We got top market veterans to chime in. Let's go across and listen.
One has to really be very careful and cautious about export-oriented companies or export-oriented sectors. So that's one place to maybe avoid in this environment. But I still think the demand for pharma is going to be inelastic. I mean, no matter what tariffs are imposed, I don't see why suddenly there's going to be an alternative source for the United States to basically buy its pharmaceutical requirements, irrespective of the tariffs imposed. So I think we will live with some uncertainty. Maybe, in a few weeks, few months now, even these two pockets would probably create very attractive buying opportunities. Metals is something which one would avoid right now because, again, it's a factor of global demand, global prices.
Given this current tariff situation continues, India tariffs lowest being only stands out as an edge for India rather than a risk for India. So Indian producers will be far better placed in terms of exporting to US than anybody else. And if that's the case, then the worry should not be there. It should be seen more as a comfort. If the commodity prices remain soft, it helps India. I think India is not in a very mega inflationary environment. We are in a reasonably well-managed inflation environment over the last many years, including during the Ukraine war time.
Barring China, the rest of the world will conclude reasonably constructive deals with America over the next 90 days. China will try to dump on everybody, including India. And the main way for us to deal with that is I think we need to consider depreciating our currency. Beijing is already depreciating the RMB aggressively. I think we'll see more of that from Beijing in the coming months. And I think we'll also have to consider flooding the system, our banking system with liquidity. The RBI has begun doing that. It's a step in the right directions. We need more interest rate cuts from the RBI. And I think we need the rupee to move towards 100, 105, given the rate at which Beijing will depreciate the RMB.
For principal protection and those who are really worried about volatility, maybe still fixed income might be a better place. But nevertheless, I would still actually think that equities over the medium to long term has the potential to deliver double-digit kind of returns. That's been the case so far. And I don't see that changing given the fact that India itself, nominal GDP growth will grow at about 10%. So I'd still think that this is a time still to be in equities and maybe use this current bout of correction to keep increasing allocation to equities depending upon one's own risk appetite.
We are in a good growth environment as far as Indian equities are concerned, economy is concerned. And at 17, 18 times price to earning, Indian Nifty does not look at all expensive. It is very, very good proposition. Whenever there's a fearful environment global level, it is rightfully that markets can be edgy. And that's the reason I believe that I don't see deep downside from here unless some, again, catastrophic event happens, globally. I mean, it's very hard. My sense is that we are in and around 500 point plus minus from here. We should be in this range, and as the earnings come out, as the issue settles down, we should resume our trajectory. My sense is that in this quarter, April, May, June quarter, all these things should settle down, and June onwards we should look good. I don't think Q1 being a washout kind of quarter for Indian corporate by and large. You can have one or two segment or sub-segment, but broadly, I don't think there's any sort of major washout expected.
Large caps, we're not that worried about valuations, but small and mid cap valuations are still unusually high. We have worked very hard in our small and mid-cap portfolios over the last 7 months to sell the expensive stuff, to go into cash, to bring the portfolio valuations down as much as we can. But I think small and mid-caps in India have another 30-40% to go before the valuations can be deemed to be attractive. Large caps are all right, especially the kind of quality large caps that we like are all right. At this juncture, at current valuations, it's not clear to me that there is a bull market button to be pressed in India. So unlike March 2020, when we were happy to buy aggressively, we're not buying aggressively at the moment because we can see the domestic weakness.
Well, that's some key commentary coming in from experts on where the Indian markets could be headed amid this tariff turmoil. But with that, it's time to take a very short break on this edition of Market Cafe. Stay tuned. We'll be right back.
Welcome back. You're watching Market Cafe on ET Now with me, Shreyansi Singh and Kanishka Sarkar. And let's get you some more news and updates then. In fact, Jefferies' latest greed and fear has increased India's weight in its Asia, excluding Japan playbook, 21% versus MSCI's 18.7%. In fact, the firm now also calls for cutting US exposure and pivoting to Europe, China, as well as India. In fact, Ashesha is standing by with some more details. Ashesha?
Well, yes, Jefferies has in its latest greed and fear report increased its weightage on India yet again by another 1 percentage point. Remember, this is the second increase in just a matter of 10 days. It was just on the 11th of April that they had increased weightage on India, and they've now yet once again increased their weightage. Now the recommended weightage for India stands at 21% versus MSCI AC Asia Pacific ex-Japan weightage, which stands at about 18.7%, which means they are overweight India, and the mismatch from benchmark stands at about 2.3%. They are clearly bullish when it comes to Indian markets, but as far as US markets are concerned, they believe they are expensive. They say US stocks are still trading at about 19.2 times forward earnings, which they believe are expensive, and they are favoring markets like Europe, China, as well as India at the cost of US markets. As far as other asset classes are concerned, they continue to remain very bullish as far as gold is concerned. They say they don't think gold has peaked as yet, and they have allocated 40% to physical gold bullion in their long-only asset allocation for US dollar-based pension fund, and 40% allocation has been done to bullion, physical bullion, 30% to Asia ex-Japan equities, 20% to unhedged gold mining stocks, and 10% to Bitcoin. So they are very bullish when it comes to Indian markets. They are very bullish when it comes to gold, but US markets, in their opinion, are overvalued when it comes to valuations, and they've also gone ahead and increased their weightage on India by 1 percentage points, which now stands at 21%.
Well, those were the key takeaways from Jefferies' greed and fear report. Now, moving on, SIP flows remain intact even if there's a temporary slowdown, says A. Balasubramanian of ABSL AMC, as he notes that unique investors have doubled in just a few years. He also advises new investors to stick to their SIPs and not time them on basis of short-term volatility. Listen in.
So the new world initially was looking extremely uncertain. But I can't say that uncertainty is still not there. Uncertainty is there, but I think the impact probably could be a bit diluted. And second, from India point of view, probably is a great opportunity from India point of view. I think the way the government has been handling quietly without making much noise, and looking at more deeply in terms of how Indian model can get adjusted, especially from the trade point of view. My belief is it might turn out to be a big beneficiary, rather India could become the big beneficiary of the whole stuff. Even from analyst expectation point of view, the earnings coming down is also already been predicted. It's not that people are still bullish on earnings and then expecting companies to outperform the analyst expectation. That's all not there. On the contrary, most of the downgrades happen from the analyst point of view. In all probability, the company either will start meeting the analyst expectations or marginally outperform the analyst expectation. That might also begin. Therefore, my own belief is it's already there in the price. And the last 2-3 months, even government expenses, expenditure, especially towards...
Alright, and that's some expert commentary to start your day, right? Tell you what, let's also take a look at the stocks that you should be keeping on your radar bright and early this morning. In fact, Gaurav is standing by with just that list.
Well, yes, first let's talk about Yes Bank, because when it comes to profitability, bank reported a growth of around 50% on a year-on-year basis, and the reason being that cost to income ratio has now gone down almost to 67% versus what it was at 71%. On the other hand, on the advances growth front, there was a little disappointment, but from here on, the outlook remains strong. On the other hand, when we talk about HDFC Life, we are seeing AP growth was actually a miss in estimates because that came in only at 9.7%, but on the other hand, VNB margins remain strong for the business. There, we also have some stocks which will be buzzing on the back of the news flow. So first let's talk about IndusInd Bank, because now the board has approved elevation of Mr. Santosh Kumar as a deputy CFO, and on the other hand they will also be relieving Mr. Arun Khurana from his additional responsibility as CFO. ITC is also going to be in focus because the company has now acquired 24 Mantra organic brand for around 472 crore rupees. BHEL is also going to be in focus today because company has said that they have registered revenue growth of around 19%, and the total order book now stands at around 1.95 lakh crore rupees. Cipla is also going to be in focus because US FDA recently concluded its inspection at one of the facilities in Goa, and they have concluded this inspection with VAI, which is voluntary action required. Divi's Lab is also going to be in focus because company has now signed a long-term contract with international manufacturer, and with this deal is expected to contribute a lot to revenue with an investment of around 650 to 700 crore rupees from the company. Adani Sports is also going to be in focus because APSEZ had recently acquired 50 MTPA capacity at one of the Australia's port, and this is actually in line with the company's view for 2030. Lastly, we will be also focusing on JSW Steel because the company has now signed a contract with Italian government, and with this they will be reviving one of the plants in Italy. We also have some companies which will be in focus on the back of the board meeting. So we have got Biocon and NHPC because board meeting is on 23rd to consider fundraising. Devani International will hold its board meeting on 24th, and DCB Bank will hold its board meeting on 25th of April for fundraising. So definitely watching out on all these stocks on the back of the news flow that were received in the morning.
Thank you, Gaurav, for that list of stocks to watch out for in trade today. Now, moving on, while it's time to be cautious in the market, India seems to be relatively better placed versus other markets. That's the word coming in from Jefferies' Mahesh Nandurkar. He adds that he'll stick to domestic-facing sectors for now while avoiding IT and metals. Listen into his expert commentary.
Not a market, where one can take a very adventurous call. One needs to, sort of take a more measured approach, take a little bit of a cautious approach as well, evaluate the stocks and sectors more on their merit in terms of what the valuation is, what is the market expecting. And I would say, basically, take a slightly cautious approach. If it goes up too much from here, the market goes sort of too much from here, maybe book profits, and buy only when you see some dips, but that too I would say in sectors where there are predictability, in sectors where there is valuation comfort, and in sectors in my view which are more domestically oriented rather than the global or the outward looking businesses.
How much of the bad news is in the price? It's important for us to look at that. Okay, how much of this entire tariff adjustment to global trade and global GDP is something what markets have already factored in?
I think, to my mind, that to a large extent, those risks, have been factored in. In terms of the sentiments, obviously, what is not factored in at this point in time is the impact that these tariff adjustments are going to have on the US, in my view, and what kind of a slowdown that will be seen in the US or maybe seen in China, because those are the two economies that seem to get impacted the most. Given the uncertainties around the policies from the US has gone up so much, I believe that US is no longer the most favored destination in terms of incremental flows going forward, and money will be finding its way into non-US assets. For the last few months, barring the last few days, it was Europe and China. But given this tariff war, even Chinese markets have also corrected. So I think non-US markets, non-dollar assets are going to see a positive inflow, and India will get its own share as well. So on a relative basis, I would say it is easier to make a call that Indian market should do better as compared to their other global counterparts. But that could mean that India falls less as compared to the rest of the world. it is not very easy to say that whether Indian markets will rally big time from here on. That's a very difficult statement to make. But so it's a relatively easier, I would say, decision for a global investor as to which markets to own. I would definitely say India is looking far better than many other markets globally. One of the factors that I would say is just the factor, which is oil. So oil prices have come down by almost $15 to $20 from their recent highs. And every $10 decrease in oil prices saves Indian economy $16 billion or nearly 40 basis points of GDP. And we are down almost $15 to $20 on oil prices. So it's almost 60 to 70 basis points of GDP. So whether that reduction in oil prices is passed on to the consumers or whether the government actually levies incremental taxes, on it, but that doesn't matter. The economy is getting that much of inflow. Whether the government keeps it or it's passed on to the consumer, that doesn't matter. But that's overall a positive for the Indian economy as such. And so to that extent, I would say the negative impact of the global slowdown or the tariffs can get offset by just this one factor, the lower oil prices. So therefore, I would say that on the relative terms, Indian markets look better. And within the market, I would definitely look at the domestic plays, such as banks or some of the select industrial verticals and so on. That's what I would say at this point in time.
Is the selling in IT slightly overdone because we all know the cause and the effect here, whether it is AI or delay in decision making? But the fact that stocks are down 15 to 30% on an average, again, is this the case where all the bad news is in the price?
See, the thing here is that the stocks have corrected, and now many of the stocks are offering a dividend yield of close to 4%. And historically, we've seen the stocks usually bottom at levels like these. Maybe there will be some revision on the downside in terms of the EPS numbers and for the dividend numbers as well. And so therefore, maybe we'll see a slight weakening on the dividend side as compared to the current expectations. So maybe much of the downside is now, there in the price as such. From here on, we could see some small bit of correction here and there. But is this the time to jump into the IT stocks? My answer would be no, because the multiples, as I said, are at the average levels. The risk is still there on the downside. So as I mentioned earlier, I'm still going to avoid IT or even metals or some of the auto sort of components which are more into exports. So I would avoid all these three segments and focus more on the domestic sectors where I have clearly more visibility and more predictability, and therefore more opportunity for the PE multiples to re-rate.
Mahesh, the SIP flows have been quite encouraging, more than encouraging actually. They have been firm like a rock. And the data which came out on Friday, again, equally encouraging. Can one be reasonably assured that the liquidity crunch what we had in the market because of FI selling and because of what was happening in the global market, that is behind us? Because why would FI sell India? India is where the growth is. India is where the safety is. India is where the tariff impact is lowest. The problem is in US. So one side is SIP flows and second side is prospects of FI selling which will reduce.
Yeah, that's true. So I'm definitely on the more optimistic side here. It's just that I'm not as optimistic as I was, say, like a month or two ago. I clearly believe that India is definitely a relatively safer place to be in. And as you rightly mentioned, the risks are there more with the other bigger markets like China and US. So that's precisely the reason why I would like to go with banks or NBFCs, which is not only offering the domestic market exposure, but also at a very, very reasonable valuations as well. So as I mentioned, I'll be very careful, in terms of my stock selection, my sector selection, because not everything is going to go up. And my sense is, we just need to make sure that the stocks and sectors that you buy into, are not going to be impacted or not going to be, susceptible to the volatility created by international news flows.
So within domestic, apart from banks, Would it be consumption or would it be capex? Would it be consume India? Would it be buy India or build India?
I clearly think that yes, the government capex growth is down for sure. There is no doubt about that. But the private capex is happening in certain pockets in a very, very visible way. And one such sector is power. And I believe that the power sector demand, the power demand has, come back in a reasonably, visible way over the last few months. We have seen February power demand was up 6%, March demand growth was up 7%, and according to the predictions made by the IMD, it looks like that we are heading into a hotter than normal summer.
All right, and that's all that we could pack for you on this edition of Market Cafe on ET Now. Thank you so much for tuning in. You don't go anywhere because the market takes all of the action forward.